Hey everyone, it's Will here with Flow Trade Effects. I'm bringing you guys a new video in my self-study series. This one's going to be on what moves the market. Now, this is a topic that I've been pretty fond of for a while. And if you're like most people or you're like me, then you might have been wondering like what exactly makes the market go up and down, and then even spend hours just sitting there and stagnant. Um, Definitely big banks in place. There's computer algorithms, brokers manipulating prices. And for a while, I even thought there was market wizards, like literally casting spells on my broker, my trading account, and literally telling me, like, creating like bad trades for me. Um, Now, after a while, obviously, I've been trading for years at this point, and through some extensive study, I realized that definitely wasn't wizards casting spells on my every trade, and there definitely could be a mixture of everything else that I had mentioned. Um, Now, one way that I like to relate to the market is the use of an antique auction. Now, when it comes down to the antique auction example, it's pretty similar because of how prices are fluctuating. You see, when prices or products supply are for sold or sale in an auction. The auctioneer will start with the base price, and depending on the varying degrees of interest for the item, the price may either rise or fall depending on the demand of that product. The more participants that are willing to buy the product, which is demand, the higher prices will rise due to that limited supply. Now, this phenomenon is equivalent to when you see prices on a chart moving. Although with the chart, something to note is that with every higher price that's demanded, less and less buyers are enthusiastic and willing to pay those higher prices. So unlike where there is a auction where you get one lucky bidder who just won the bidding war and walks away with something extremely rare, you'll have a sucker who is pretty much the last buyer in an uptrend. And we've all been the sucker. Every successful trader has probably been the sucker at one point or another who buys when no one's willing to buy higher than them and thus trapping you until, price goes in the opposite direction, offering lower and lower prices until ultimately finding a pool of willing buyers who are open to bringing prices back up again. Now, I can show you guys this example with one of these charts right here. Now, when we use this chart, we're able to see various areas where this is an up auction. This price incline on the upside is a price auction, and this price decline on the other side is a price auction. This is a down auction, and this on the other side would be a left. On the left side would be an up auction. This price started down here and went to the upside, and then created this peak. And then this is a start of a down auction where price came up here and came down back into this area here. Now, here we can note two areas and two pools of different people. Now, what different people can you notice by looking at a chart? Like, there's nobody's profile here. You don't see anybody's names. Well, we can just categorize these different types of people as willing buyers down here, who anytime the price gets down here, there should be buyers who are willing to buy it. And then there are willing sellers. Anytime the price comes up high enough into their range, they should be willing to sell it off and let you guys and let the price come all the way back down. Now, of course, that doesn't necessarily always happen. There are definite news impacts that can, contribute to the outcome of the way that the market is going to move. And then there's definitely the momentum factor, which can be displayed by supply or demand in either direction, whether it's an up direct down or whether it's an up auction or a down auction. Um, Either way, you're going to find supply and demand, and as supply and demand dwindles or changes, you'll find momentum is usually an indicator of that as well. The less momentum, the less sustainable any move is going to be overall. That's just something to keep in mind. Now, when considering an auction as, or when considering the market as an auction, we must view the price or the product being sold as price and the people buying or selling as the momentum. Now, when there's no longer any momentum in one direction, it's likely an indication of the next offering being in the opposite direction. Now, I've explained how the market prices move using an auction as an example. The next part is probably going to be to gauge the strength of that momentum so you don't end up being the sucker who is literally buying at the top when no one else is willing to buy, and then selling at the bottom when no one else is willing to sell. We want to be where there is willing buyers and we want to be where there is willing sellers so that we can always be in flow of where the market is moving. Now, this is a relatively simple breakdown of a highly complex topic, and it's something that takes time and practice. But overall, once you do start to realize this, you can definitely better position yourself to be in more profitable scenarios and at least be in line with where price is looking to move. Now, if you've enjoyed this video, I really hope that you give it a thumbs up. And if you have any questions or comments, or maybe you have another opinion on how the market moves, leave me a comment down below or shoot me a message. If you do enjoy this video and you want to see more videos, any future content that I put out, definitely subscribe. And I would love to hear from you guys. That's going to be it for this video on what moves the market. Um, yeah, you guys stay happy, stay positive, stay profitable. I'll see y'all in a little while. Check y'all in the next video. Peace.